Hello, welcome to the class. As I have already told you, in this semester we are going to study investment management. So what is investment management? What are different avenues of investment management? Where to invest? Where not to invest? What are the different ways to invest? Yeah, all these advantages, disadvantages of investment. Yeah, some investments are told as investments, but actually they are not investments. So all these concepts we are going to study under investment management, yeah, in this paper, in this particular semester. It is a theory paper. Most of the concepts are theoretical concepts, whereas you can expect two practical questions, one in section A for 2 marks and one more in section B for 8 marks. So only two practical questions will appear for the exam. You can attempt them. Both of them are very easy and simple. Remaining is all about theory. 5 chapters are there. Yeah, 5 chapters are together. Total 6 chapters are there. 5 chapters theories you will get. In the first chapter, we are seeing some basic concepts of investment. What is investment? What are the features of investment? What are the benefit of investment? And some of the avenues of investment like post office, gold investment, investment in land. Idella concept now ನೋಡ್ತೇವೆ. Now we'll see in today's class the basic things, some definitions about the investment, and yes, some definitions about the investments we are going to see. At the same time, features of investments, what are the objectives of investment, what makes you to invest somewhere. Yeah, so these things we are going to study in this in the first chapter. Yes, so we'll see the things. Definition. First concept is all about definition. Just see to the things. So what is this, what is investment? It is given there. It is given by different authors. Some 4-5 definitions are there. All I have put them together, and after this I will send you a PDF of the notes. By seeing that you can write. Yeah, you can write the notes. Now we'll see this particular definition. Now what it says: the creation of more money through the use of capital. So we'll see what happens is there is creation. So creation of money. So creation of what? Money. What is that? More money we will create. From what? Through what? Through the use of capital. So that means you will use capital, and through the usage of the capital you will create more money. And how you will yes, so that is what we'll call it as investment. So you will whatever capital you have, out of that capital you will create more money. So that is the definition of this particular that is the definition of investment. So you are not creating from something else, from capital is also one form of money only. Capital is also one form of money, and from that capital you are going to create the more money. So that is what I'll call it as that is what we'll call it as investment. Now we'll see one by one. We'll see each concepts whatever are available here. First of all, creation. What is creation? Creation means making more. Maybe it may be manufacturing, it may be production, or it may be adding something. Yeah, so through that we will make something. So that is creation. So that is what we will call it as creation. You are creating something. What you are creating? You are creating more money. So money or money's worth. Like for example, you have 10 rupees, you will create some more money. 12 rupees you will make, and 2 rupees you will add, you will make it as 12 rupees. So how you can do? By using this as a capital you can make the money. So more money you will create through what? Through use of capital. Now already we have studied when it comes to money, or when it comes to assets. Yeah, two types of assets we have studied, current and fixed. Yeah, liabilities also, current liabilities and fixed liabilities. So all those things we have studied. Yes, now capital is a thing in our accounting concepts. Capital is money which is belongs to someone else. Now here from this what we can understand here is capital is a amount, it is a amount which is kept as a fixed amount. So that is what we can call it as capital. So out of this particular capital you will create more money. So that is the definition of this particular investment management. So we have studied definition number 1. First definition is over. So you will create more money by the use of capital. So that is the first definition which is available related to investment. There are many definitions. This is one of the simple definition what I have mentioned it for you. Money is creating it is creation of more money through the use of money, and this particular definition was given by Campbell Harvey. So all these things I'll give it in the PDF, so you can see that and you can copy it. Now one more we'll see the little big definition. The act of placing monetary resources into financial assets. So what it is? Act of placing monetary resources into financial assets. So the monetary resources, that is money or money's worth, into what? Into financial assets. Monetary resources are converted into financial assets, and that is what we'll call it as investment. That is one type of investment. So what we will see, that is the purchase of shares or bonds. Yeah, so here what happens is you will purchase something. Yeah, enta helidare monetary resource in the financial assets madidare. So that means you will purchase something. You purchase of what? Shares or bonds. Yeah, so here what happens? Shifting money from bank account to the securities, securities, or cash to securities, in the way of it simply moves savings from one form to another. So here what they are telling is, from one savings you will convert it into one more saving. So that is what we will call it as investment. So here some of the things what we are supposed to consider is, from monetary source you will make it as financial assets. You have money in your bank account, or you have some cash amount. Out of that you will purchase something. Maybe it may be shares, it may be bonds, it may be one kind of asset, it may be gold, it may be any kind of financial assets. It may be financial assets means those assets, in return to that you will get money. If you sell that you will get money. So that is what we will call it as financial assets. So you can measure it in the form of finance. Yeah, in the form of finance. So that is the concept what it is told here. So these financial assets are considered as investment. So that is a concept here. So you will purchase something here, and to purchase that you have to pay money, normally from bank account. This is monetary resource. You will convert them into financial assets. So that is bank account into financial assets. So that is the concept what we are supposed to consider here. So these are the two definitions. First definition says creation of more money through the use of capital. Here it says monetary resources are converted into financial resources. So these are the two definitions what we are supposed to consider. So we'll see. So these are the basic things, definitions. So out of that we'll get some idea about the investment. So you are creating more money. You have little money, you put it somewhere, you convert it into some kind of assets, and through that you will get more money, you will get more return. So that is what we'll call it as investment. So that is these are the basic things about the meaning of investment. We'll see to the next concept. It is objectives of investment. What are the objective? What makes us to invest? So these are the concepts we are studying here. It's all right. These are the objectives of investment. One by one we have to see. Effective cash management, optimizing of risk and return, maximizing tax benefits, minimizing tax indices, diversification, portfolio designing, portfolio churning, minimizing transaction costs. So these are the various objectives of investment. These concepts or these ideas make us, or they will encourage us to invest. So we'll see these concepts one by one, what these are, what we have to do, all these things we'll see. First of all, effective cash management. So in each point we'll see the keyword. So here it is cash management. So here cash management, how you will do. So some people invest for the purpose of the main purpose is to manage their funds, cash, liquid cash. Now here one thing we should know about liquid funds or liquid cash or liquid liquid assets. So one of the biggest type of liquid asset is cash. So anytime if you have cash, anytime anything you can purchase, or any assets which are equivalent to cash. So now what happens is you cannot hold huge amount of cash in your hand. Yes, it may have its own disadvantages. So that's why you have to put it somewhere. You have to safeguard your cash. So how you will safeguard? Sometimes you will keep it in your bank, sometimes as SB you will keep, sometimes you will keep it as FD, fixed deposit, for a particular period of time. Or sometimes it is something like this. What happens is it is like you will purchase an asset. Yeah, so here one intention is, when you want money you can get it through selling those particular asset. One more intention is creation of value. So whatever it is, you want to manage your cash, either you have to keep with you, or you have to keep it in your bank, or you have to purchase some asset. So whatever it is depending on your idea and your intention. So that is first concept, effective management of the cash. So easily, effectively you can manage your cash. Now optimizing risk and return, the concept of risk and return. So what is this risk and return concept? Now already we have studied, or you maybe came across this, where there is risk there is more return. More risk, when there is more risk there is more return. Similarly, when there is less risk there is less return. So whenever you are investing, you have to see this risk return portfolio, you have to study properly, and you have to invest in such avenues where there is more return, and less risk. So risk should be always less. With less risk, with less risk you will get more return. Such investment avenues you can choose always. Like for example, gold. If you purchase the gold, there is capital appreciation, there is return, but there is risk, you have to safeguard it. So all those things are there. If you are investing in the share market, you may get huge return also. At the same time, there is a risk of losing everything. So that is also there. So these are the things, optimizing risk and return. You have to study properly, then you have to invest. You have to see that where there is less risk and more return. So that's a concept which we have to consider. Then maximizing tax benefits. Now tax benefits you should get. So you have to what you have to do, you have to maximize the tax benefits. How you can maximize tax benefit? If you have money, you will keep it as keep that money in a bank, or if you keep it in one particular avenue, on your income definitely there is tax, alwa. So that's why smartly you have to invest. So if you invest smartly, you can minimize the tax. You may know, and already you have studied, there are some sections like section 80C, you can invest up to 1,50,000. Like that there are many, 80D, 80DD, so many are there, we have studied already. So out of in all these from all these sections, what you come to know is where you can invest, and what deductions you will get. So all these studies you have to do, and based on that you have to do the investment. So that is minimizing tax, maximizing tax benefits. Then minimizing tax incidence. Now ಯಾವಾಗಲೂ ಟ್ಯಾಕ್ಸ್ ಬೆನಿಫಿಟ್ಸ್ ಅನ್ನು ನೋಡಬೇಕು, ವೇರ್ ಯು ವಿಲ್ ಗೆಟ್ ಮೋರ್ ಬೆನಿಫಿಟ್ಸ್ at the same time where you can pay less amount of tax. So in those investments you have to invest. Like for example, already I told ATC investment. Under ATC there are something around 20 to 30 investments where you, 20 to 30 areas where you can invest. So if you invest there, you will get deductions, and that deduction is also up to 1,50,000. So up to that amount you can do the investment. So these 2 points will go hand in hand. One is you have to maximize your tax benefits. You have to see that more tax benefits you will get. At the same time you will minimize tax incidence, andre you have to pay less amount of tax, and that is also ethically. Next concept is diversification means what it says is, when you are doing the investment, some people will do the investment for the purpose of diversifying. Now you keeping all the money in your hand is not good. Instead of that, you will put something in, some amount in gold, some in land, or some in mutual funds. So suddenly whenever you need money, you can if you need money at that time, you can get that particular money. So that's why you should not keep your money in one particular avenue, but you have to keep it in different avenues. You have to invest in different avenues. That is one more objective of investment. Instead of keeping in one particular place and losing everything, better what you do is you can put it in different ways and different areas, and you can get some return. So that is the concept of diversification. Next two concepts, portfolio. One is designing and churning. Together I'll explain these two concepts. What is portfolio designing and what is portfolio churning? Now diversification concepts itself will clarify us what is portfolio. Portfolio means where it is a group of different investment avenues. So you have 1 lakh rupees, you will invest in 5 different avenues. Some 20,000 will consider 20,000 each. 20,000 in bank, 20,000 in land, 20,000 in gold, 20,000 in share market, 20,000 in mutual funds. So when you do in this way, in one or the other way, definitely in one or the other area, definitely you will get a return. You may not get a return if you invest all the money in mutual fund. Share market crashes, you will lose all the money. But in case of portfolio, from one or the other avenue, definitely you will get return. So that is portfolio designing. Portfolio churning means, now every time this particular share our portfolio may not remain same. Sometimes what you have to update it. This year you have invested 20,000 in mutual funds. Next year share market is going up, you are investing 30,000 there. Or gold rate is going up, you are investing 50,000 in gold. So this is the thing. Regularly you have to study, and based on your study you have to update your portfolio design. So that is what we'll call it as portfolio churning. Last concept, minimizing transaction cost. Now sometimes many times what happens is, regularly you will buy, sell, whenever buying and selling take place, you have to transfer the title, registration is to be changed. So all these procedures will involve, so which includes registration charges, then buying charges, selling charges, commission, brokerage, all these concepts will come. So when all these concepts comes, your transaction cost increases. So when transaction cost increase, it is a loss for you. You have to lose a big amount of money. So that's why you have to you have to minimize the transaction cost. So these are the objectives of investment. Cash management, you have to manage your cash. Optimizing risk and return, you have to see that there is less risk and more return. Maximizing tax benefits, you have to see that where there are more benefits, there you have to invest. Minimizing tax incidence, you have to plan properly, and you should see that I will pay less tax. Diversification, you should not put your money in one area, you have to put it in different places. So that itself is called as portfolio. You will design it properly. Regularly you have to update this, and regularly selling and buying you should not do. So these are the concepts what you have to consider, understand it. I'll send the notes for this little later, then you can write. Thank you.